Hey guys, it's Vivian, your hot stock girl. Today I'm going to give you a brief overview of paying taxes on your investment gains. I am not a tax expert, and if you make a significant amount of money in the market, you should hire a tax professional. When you buy and sell a stock for a profit, you have what is called a capital gain. If you held the stock less than 1 year, it is called a short-term capital gain. If you held the stock for over 1 year, it is called a long-term capital gain. Long-term capital gains have the benefit of paying a lower tax rate, whereas short-term capital gains are taxed as ordinary income. As ordinary income, you pay the same tax rate on your capital gain as you do on your wages you make from your job. There is no tax benefit on short-term capital gains, but if you are in a low tax bracket, you only pay the tax rate from your bracket. If you are in the 10% tax bracket, you pay 10% tax on your short-term capital gains. If you are in the 35% tax bracket, you pay 35% tax on your short-term capital gains. Long-term capital gains is where you reap the benefit of paying lower taxes. If you are in the 10% tax bracket, you pay no taxes at all on your long-term capital gains. If you make over $500,000 a year, you are in the top tax bracket, which taxes wages and short-term capital gains at 37%. So if you earned $1 million of short-term capital gains, you are paying $370,000 in taxes. But if you earn $1 million in long-term capital gains, you only pay $200,000 in taxes. You would save $170,000 having long-term versus short-term capital gains. Obviously, if you earn that much, it pays to have a good tax accountant. Qualified dividends receive the same low tax rate as long-term capital gains. That is one of the reasons wealthy investors buy stocks that pay dividends. Since ordinary dividends are taxed at ordinary tax rates, you have to understand what makes dividends qualified. Qualified dividends are dividends issued by the U.S. corporation and held at least 60 days before the ex-dividend date for common stock and 90 days for the ex-dividend date for preferred stock. Some foreign dividends could be qualified, but it's tricky, so I recommend sticking with U.S. corporations. As for stock traders, if you make less than $150,000 per year, you will only pay about 10% more than long-term holders, so keep on trading. If at the end of the year your capital losses are larger than your capital gains, you can deduct up to $3,000 of your net capital losses from your ordinary income. If net capital losses are above $3,000, you would carry forward everything in excess of the $3,000 to apply future year's income. For example, if your capital loss at the end of the year is, say, $10,000, you deduct $3,000 against ordinary income this year and carry forward $7,000 to apply the next year's income. Once again, if your taxes get complicated, hire a tax professional. So there you have it, my thoughts on capital gains tax. I'm Vivian, your hot stock girl, and please be sure to subscribe below and check out my other videos for more great investment ideas.